Let's bring in Dominick Tavella. He's the president of Lebenthal Global Advisors. Dominick, thanks for joining us this afternoon.
Good afternoon.
I want to get in a little bit more of what Lucas was discussing from the White House here. Here's Gene Sperling trying to explain what the White House is saying is the reason for this.
Understanding why gas prices have gone up. January 17th, that is the day Putin moves troops to the border of Belarus and Ukraine. Gas prices are at $3.31.
The prices were going up prior to that, though.
I know, but they had gone up, but they were up at $3.31.
So two things here, Dominick. First off, what about the White House's argument that it's something that is also an international event? It's not necessarily in the full White House control, that prices are going up around the world, not just here in the United States. And are voters buying that explanation?
Well, the poll numbers themselves tell you all you need to know. The voters, the population here in this country, are not buying it. Oil and gas prices were going up way before the Putin invasion of Ukraine, and clearly that has made a bad situation worse. But it was this administration's energy policy from the day they got into office that dictated higher prices, and they're getting what they wanted.
The administration also argued earlier on that it was not necessarily leases that they were no longer approving and then decided that they would go through and approve more leases, but it was companies weren't drilling on the land that they had gotten leases for. How much can the administration now reverse course and affect gas prices, or is this something that is largely out of the White House's control?
Unfortunately, I do believe it's pretty much out of the White House's control at this point. We literally have 1 million gallons of barrels of oil a day less production than we did before this administration took office. So even if they just reverse course and they took their anti-energy stance away and said, let's start drilling or let's start production, let's co-partner with American companies to produce more oil, more gasoline, it might be 6 months to a year before you saw any real significant increase in production.
Now, Republicans are making the argument that the $2 trillion stimulus proposal, rescue proposal that Democrats approved early on in the Biden administration is largely to blame for what we're seeing inflation, not just in energy, but across the economy. How much of that $2 trillion contributed to these increased prices that we're seeing?
So in all fairness, first the Trump administration, which started stimulus, and then the Biden administration, no one knew how long that recession was going to last and how long the economy was going to take to recover. Looking at that in retrospect, they clearly pumped way too much money into the economy way too quickly, money that maybe at that time wasn't needed, and we're seeing the ramifications of that. And this week we see where Treasury Secretary Yellen was quoted as, we don't know if it's true, but she was quoted as saying too much stimulus too quick. And a lot of that, unfortunately, went into fueling the very inflation that we're dealing with right now.
And, you know, what about the Treasury Secretary? She's denied that she argued for a smaller stimulus plan, but she has acknowledged that she didn't see this coming. The Federal Reserve has a job to try to bring prices back in control, inflation back into control. How much can the Federal Reserve do here? Were they a little too late in increasing rates? And do they risk raising rates so much that they could also affect the broader economy and slow down some of the positives in the economy?
Yeah, it's a great question, Rich. So clearly the Federal Reserve has acknowledged that they've been behind the curve here. They should have started much earlier and much more gradually so their impact on the economy wouldn't have been as severe. At this point, they're playing catch up. And we know at least for the next 2 months, they're going to raise interest rates about 50 basis points. But what does that actually do? It slows the economy down. So the very people right now that are suffering, paying higher gas prices and higher food prices, are potentially at risk of losing their jobs. So we have this dual battle between slowing the economy down and not pushing it so hard that we push it over a cliff into a recession.
And Dominick, real quick, do you think that we're headed for a recession?
Honestly, the leading economic indicators which we follow say this year, no. I think we're safe this year, but much slower economy in the third and fourth quarter. Beginning of next year, depends how hard the Fed has to push on brakes of the economy. If they push too hard, you could be looking at a recession early next year.
Dominick Tavella, thanks for joining us.
Thank you.